tips for trading. As always, thank you for tuning in. And now, let's focus on today's episode,
The
257.
shadows dance like mischievous sprites.
I'm thrilled to introduce
What's your plan to
David
outsmart those lurking
Capablanca.
foes?
You may know him as the host of the Friendly Bear podcast. Being deep in debt after finishing architecture school, David realized that he wanted an alternative career with independence, freedom, and potential for higher earnings. From what I've learned about architects in general is that they are artistic, imaginative, but also logical and investigative in nature. So it's no surprise that you'll hear elements of these traits come through in David's trading approach. He's naturally drawn to a contrarian psychology and zeroed in on short selling as his trading of choice. The challenges of uncovering scams through a deep dive into company fundamentals, the history of founders, and visiting company headquarters overseas on a quest to find clues were the kinds of things that energized David and brought his trading approach to a whole other level. Although he's no longer in architecture, you can say he became the architect of his own trading destiny. Let's allow David to take us on a short adventure with him today, shall we? Ladies and gentlemen, we're so pleased to present David Capablanca from the City of Angels.
All right, I'd like to welcome David Capablanca, host of the Friendly Bear podcast, to chat with traders. Welcome, David.
Yeah, Ian, how you doing? Pleasure to be here.
Yeah, great. So, curious, are bears unfairly characterized as being vicious creatures?
I think so. As we can tell, there's a new movie out. And yeah, that's exactly what they're portraying in the movie.
However, you're much friendlier, and you'd like to share with us a little bit about short selling today.
Absolutely. Yeah, I am the friendly bear. I like to have conversations with the other side and just be friendly in general, you know? So yeah, absolutely.
Yeah. Give us a little bit about your background before you got into trading.
Okay, a little background. So I came into trading late in the game in my 30s, and I have a background in architecture. I spent all of my 20s in the architecture field, in college for architecture, undergraduate and graduate, and I was focused solely on becoming the best architect I can be, and I really enjoyed it. I really enjoyed architecture school, and just excelling in the creative, imaginative field of architecture and creating and design and everything about it and everything that came with it as far as travel and culture and everything. So I was really good at that. However, when I finished undergraduate and then graduate school, which is like altogether, it's almost 10 years of school. 6 months after you graduate, you're hit with the bills, the student loan bills and all that. So I was so enamored with architecture and just loved it so much. I just didn't even consider like the financial implications, because I was basically financially illiterate, you know, just like a lot of my colleagues were, you know, are even now. So, you know, both of my parents are immigrants. They came here. My mom's a teacher, and my mom has a master's. So like the only way I knew was to just go to school, do the best you can in school, and then that's everything else is going to figure itself out. But in the middle of all that, I was just financially illiterate. So like I got myself caught up in all these student loans. And then when I graduated, I was 6 months later, it hits you. And I was like, okay, now you try to figure it out, like how much you're making, how much you owe, and like how much time is it going to take to pay it off. I'm going to be in my late 50s, but with the way architecture is, and I won't be able to design what I want to design, because I'm going to be working for someone else doing what I don't like to pay the bills until I finish paying the bills. So trading came along, you know. So someone mentioned to me a long time ago, what I used to be caught up with, like fantasy baseball. I loved fantasy baseball. And someone told I would do very well with fantasy baseball. And we can go on another topic. That's a whole nother podcast. But one of my friends told me at the time, he told me, man, David, if you were to put this much energy and stuff into stocks, you'd be like a millionaire. And I didn't understand what he said. But then like later on in the future, after graduate school and architecture and all this, I started to see these YouTube ads popping up about stocks and trading. And then it occurred to me, a flashback happened. I was like, okay, so my friend that told me about the stats and fantasy baseball and all this, maybe I should give this a shot. Maybe this is like something that you treat as serious, just like I treated architecture serious and went to school for it and put countless hours to design everything I was designing and to learn the computer programs, to learn all the intricate details of art and history and design and all these tools and algorithms. There's actually algorithms in architecture that come up with design forms considering all the forces around that affect the building, like sunlight and wind and nature, etc., culture. So I don't know. So everything made sense to me. Okay, so if I can do this stock thing and just treat it seriously, I can make something out of it. And that's what was my approach. I wasn't expecting to make money right away.
Did you study before making any significant trades, or did you just jump in
Yes.
and learn on the fly?
No. I studied for 3 years. I didn't make any money for 3 years.
So what kind of books did you read, if any, or did you just watch videos?
I watched videos, about 10,000 hours of videos, and I started with a $2,000 account. And I didn't make any money off from 2016 to February 2020. So yeah, just studying all the videos. That course that I signed up for had about 10,000 hours of stuff. And to me, that was enough foundational material. And there was, here and there's some rabbit holes you can go to. And the thing is that the whole thing, it was all short selling pump and dumps. These are old pump and dump patterns from the early 2010s that I was studying over and over. OTC, over the counter stock pump and dumps, paid pump and dumps, all this. Then you go into the rabbit hole studying the history of pump and dumps, like the Wolf of Wall Street. I remember the Wolf of Wall Street movie came out at the time.
But what attracted you specifically to short selling? When you first got into the markets, you were studying it during the gentle bull markets of 2016, 17, 18, and so forth. Is that correct?
Yes, exactly. And I didn't make a dime. I was tutoring on the side. I left architecture at this point. I was doing it very minimally. I was tutoring architecture just to make enough money to pay my rent. And then I just studied nonstop, everything. So I decided early on, just focus on short selling. So there was like two in the courses I was taking. There was two very successful short sellers that started with the amount of money I started with, just a couple thousand. And I just followed what they had to say. As far as like their teachings and the way the risk management, their patterns, I just followed it. And to learn, I didn't make any money at all. So and I just decided, I'm just going to stick with short selling. Short selling is enough for me.
Why is that? What was it specific about short selling that attracted you when so often we end up hearing about people making lots of money being long?
That's a good question because, short selling, it takes more capital to even do it properly. And I didn't have much money. Margin account is $2,000. So I started shorting with a $2,000 account, just a couple shares, because I knew that's what I was going to do. And I was like, you know what, eventually get some money together and do it the right way. But I need to learn. So I learned by trading the smallest amount of shares. And those two short sellers I mentioned, they were primarily short. And I realized, I was like, why do they even go long? Just stick to shorting, So I decided that. And also, I guess my personality, I have thick skin, I'm just like, I always liked the characters, like even Batman's considered like the Dark Knight, right? He's not just like the Knight. He's not the White Knight. He's the Dark Knight. Or like the characters, the villains even, or I don't know, not to say I'm a villain, but I felt, I always liked it. I was intrigued, I wasn't, I liked being on the other side of the contrarian. I really embraced the contrarian view, and to the point of being a short seller contrarian.
Mm-hmm. A lot of people think of shorting stocks because they're overvalued or the charts show them as being overbought. Maybe they missed earnings estimates, and some short because they want to uncover outright frauds. Did you short stocks on using those different methodologies, or did you zero in on a particular type of short?
So at first, what attracted me right away was like the frauds. I was like, I didn't know anything about finance or markets or stocks. What made sense to me was when someone explained it to me, like an elevator pitch. It's like, hey, there's this character in here. He's greedy. He's doing drugs or whatever, and just wants to, like Wolf of Wall Street, and wants to pump this stock. He has a ton of shares and he's going to dump it. And like, he gets away with it. The SEC doesn't have enough people to monitor this stuff. So we as short sellers got to come in there and bring balance to the market in that way. So that made sense to me. And that's how I got started. But then, you you study and you work on patterns, and you have this, I have a competitive drive where like I just want to improve all the time. And I just loved it. Just like I approached it like with architecture. At first I decided to do architecture because I liked baseball stadiums, growing up. And then like it become after like 6 months or 8 months of architecture, I decided, after reading up on like artists and architects and materials and seeing buildings from around the world, like pictures of them, and then you move away from that and you get obsessed with it in a good way. That's what happened with me with short selling. I was like, okay, so I just decided to just focus on short selling. So after the pump and dumps, I decided, there's all types of shorting I could do. So I started with the OTCs. In the OTCs, I saw everything as a pump and dump, not only the ones that are specific pump and dump patterns that I learned to start with, but then I started looking into like, okay, what other patterns that are similar to pump and dumps, that pump and dump over a smaller time frame, that pump and dump because of someone on Twitter is pumping it. Like, who are these Twitter guys?
Hmm. So you mentioned the OTC market. Did you exclusively focus in on that market, or did you also short stocks on the New York Stock Exchange and NASDAQ and others?
Well, to start, I started with the OTCs because the OTCs is a slower market and the competition there is less. So I saw myself early on, this was just clear to me, that like I want to compete against people that are not sophisticated, let's just say. And the OTC market is like that. And I saw immediately after it clicked, it's like, okay, there's no algorithms trading here. There's no big hedge funds trading here. There's none of these sophisticated players in the OTCs. There's just like Wolf of Wall Street kind of stuff going on. So I started with that. And then eventually you graduate from that, so I saw that as like the minor leagues. And then I graduated. And then now, the NASDAQs also, and even New York Stock Exchange recently, the past year or so, it's just rampant with all this like chaos. And, so there's pump and dumps everywhere, every single day. So like, it's just run amok because ever since all these newer traders came in post 2020, there's a lot of opportunity on the short side.
Did you research the stocks to see how much institutional ownership they had, and would make a decision possibly not to short a stock if too many institutions were in the stock?
This is a recent thing that I've started doing. Yeah, the past year and a half or so, since I advanced my trading. Now I have all this journaling and extensive data tracking that I see the stuff more clearly. So, you're constantly trading. My trading is improving. And yeah, recently I started to consider that a lot. Institutional ownership. If there's institutional ownership present in a NASDAQ or New York Stock Exchange stock, they have algorithms, and these algorithms, they're designed to buy around the VWAP for their clients at certain levels. And stocks, they won't break down as easily. So if I'm short something and it's not breaking down, that gets really annoying and frustrating. And that can eventually squeeze, because if I'm feeling a certain way, a lot of short sellers are feeling that way. I like to think of like the crowd. It's like, if you go to a sports event, when someone yells or is happy, everybody's happy. So like 90% it's like that with short sellers. So whenever I see a trade, I'm like, okay, this is like a baseball. If I'm feeling a certain way, I imagine like a baseball stadium or basketball arena of people like me feeling a certain way. So if I'm getting squeezed or feeling like I'm going to get squeezed, that is amplified. All the short sellers, for the most part, in general, are feeling that way. And that's an indicator for me to get out. And I notice like with high institutional ownership, it's designed for the short sellers to feel that way.
Mm-hmm. Early on, I mean, you did a lot of studying before you got into the market seriously. What were some of your early weaknesses encountered with psychology, strategies you used, and risk management?
That's an excellent question. So early on, I guess patience for the right plays constantly until a certain level. I think I started to get, you always got to improve on discipline, no matter how disciplined you are, because you have that human element inside you to make errors. So yeah, just that, and noticing that right away, and noticing there's things in my life that I have to clean up. I had to clean up my whole life outside of trading before I really started to take trading seriously. Because, for example, I used to go out a lot, being from Miami, South Beach, like all the kids, all the teenagers, or what do you call it, 20-year-olds, they all hit up South Beach. I had to stop doing that right away. So I noticed, like, to be successful at this, I'm going to have to changed my whole lifestyle. I stopped partying. I gave up alcohol. I haven't drank alcohol since 2020, since I started to get profitable and excel. I had to give up a lot of toxic people in my life. I had to change my friends, my surroundings. I had to constantly just tweak my lifestyle so it fits for trading, for me to excel at trading, to reach my full potential at trading. That's what I realized early on, and it was just a constant battle to fix things. Like, for example, here in the West Coast, I don't know where you guys are. Are you guys in the West Coast?
Yeah, we're in Seattle.
Oh, Seattle. So yeah, in the West Coast, the market opens at 6:30 a.m. And in 2020, when I started trading like for real, the market, I saw a lot of pre-market opportunity of all these COVID stocks that would fly up in the pre-market and then fade all day long. West Coast is 1 a.m. And then the regular hours is 6:30 a.m. And I remember I had a car at the time, and the car was giving me a problem because like I was street parking. Because street parking at 6:30, you had to move it once Tuesday, Thursday, another day is Wednesday, Friday, and it was a disaster. And on top of that, you got LA traffic, you have parking, not only parking spots, but parking everywhere, and parking is an extra expense at where you live. So I decided, okay, I had to really think about it. So like, you know what? I got to get rid of my car. And if I get rid of my car, LA doesn't have good public transportation. They don't have a sophisticated subway system like New York or something. But they do have a subway in downtown LA. So I was like, you know what? My lease is ending. I'm going to have to move to downtown LA. I'm going to have to change my whole lifestyle because I want to make this trading thing. I have to make this work. This is my decision. This is like, I decided like Hernan Cortez, burning the boats.
So you mentioned that you like to focus in on frauds. Have you heard of short selling groups like Hindenburg Research, and perhaps had a chance to read these short reports?
Yeah, absolutely. Starting out when I was shorting the OTCs, there was this company called PRED, Predictive Technology. It was a fraud that was, I hate to use the word fraud. You got to be careful saying the word fraud, but it was a pump and dump that would send out paid disclaimers and paid emails and paid text messages, campaigns to pump the stock, and it was pumping forever. And Nate Hindenburg Research, he's like world famous now. He was lesser known back then. I don't want to say starting out, but he would also be on the same message boards as me starting out. And I would call, this is me brand new, almost like I was studying and putting in work, but I would go on the message boards talking about this company, saying it's a scam. And then Nate would come in there and say the same thing, and we would talk on Twitter. Now I was like, and then Nate, like, he really came through with the crazy report on PRED, hired an investigator in Colombia, and they found the whole scam. Or like, it was actually not Colombia, it was another place. But he hired another investigator. He had a whole process for that. And I had a small relationship with Nate, but to see his growth, yeah. So ever since then, that was one of his best reports. But ever since then, he's grown tremendously. And now it's Hindenburg Research, everybody knows. But that must have been 2019, where he was in a short amount of time. So see, like trading, if you do things right in a short amount of time, you can have a massive amount of success. It's like really is like a front, like one of the frontiers, one of the American frontiers.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, If only I had the capital. Or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Tell us about your own investigation of a cannabis company called Flora Growth.
So Ian, I think you mentioned off the podcast you went to Bucaramanga, Colombia. Yes. They do like parasailing over there, and so anyway, I did go to Bucaramanga, and Bucaramanga is a city in Colombia in the middle of nowhere that's known for parasailing and some outdoor activities. But I was there to investigate a marijuana cultivation facility that was supposed to be like world changing, and this new, this company Flora Growth is gonna export marijuana all over the world for 6 cents a gram, and it's gonna change the whole marijuana industry. This little tiny company in the middle of nowhere. So the same thing with predictive technology, the one I mentioned with Nate and Hindenburg. They sent out text message campaigns, email campaigns. That's how I got on my radar. And then I just looked into it. One thing that graduate school and architecture taught me was to do how to do research. So I have a really rigorous way to do research, that rigorous, I guess, skill to do a really good skill that graduate school taught me, and like how to do research extensively. So I did a lot of research on Flora Growth. I found out everything about the company with the backers in it, the insiders, their track record, the history. I found like a photo of one of the insiders with taking a selfie photo with Jordan Belfort back in the day, and like swindling. He was part of many pump and dumps. So like you just going down these rabbit holes and you discover all this dirt. And I was in a unique position where I was in Puerto Rico trading out of an office there. And, I met up with another short seller that does short reports, and he has a lot of resources. So I told him everything about it, and we both did a lot of research on it. And then I volunteered. I said, you know what? I speak Spanish, and I love traveling. So this is a really good excuse to travel. So I went to Bucaramanga on a flight from Puerto Rico, direct flight. I landed in the Bucaramanga airport. It's in the mountains. I took a motor taxi to a hostel. I wanted to stay. One thing I like to do is stay with the locals and see how it is. I can ask a lot of questions. So I stayed in a hostel, and I asked everybody where this cultivation facility was, and I had the coordinates pretty much. So anyway, people are trying to convince me to do parasailing, and I was like, you know what? I just want to find this. I'll do that next time. And the morning we went straight to the cultivation facility. It was really hard to find. The thing is with Bucaramanga, when in the mountains, when the sun sets, there's no more light. There's no street lamps, there's no electricity, there's no Wi-Fi. It's all dark. So like we had to really coordinate. It took 3 tries to find it, and then finally found it. And one of the I did like a surprise visit. It's like unannounced, and one of the execs came out and was really angry, and I documented it, filmed it. I had a camera on my shirt, like a hidden camera, and he documented everything, and it turned out to be like a Hollywood set. It's just exactly what I imagined. It's a Hollywood set, probably 100 feet by 100 feet, with the Flora Growth sign, and probably plastic trees. I didn't go as really close enough, but it was just a scam. It was a scam, and once we published the report, it was at the all-time highs. The day I was at the site, it was all-time highs, and then when I came back, because I had to pose as an investor, and NASDAQ companies, they're supposed to let you in to as a tour or to check out the company. They can't just be like deny you. And I said I was an investor. I'd like to check out the property and check out the plants, and they just got really angry. And they actually had guns and stuff. So like I don't know if it was loaded. This is Colombia. You know what I mean?
Right, right. You mentioned that the NASDAQ has rules requiring that investors have some access to physical facilities. Is that correct?
That's correct. That's correct. And a
Uh-huh.
lot of these scams, they locate them outside of the country, the actual physical stuff, because like people can't go there and see for themselves. And you see this a lot with Chinese companies. There's a really good documentary called The China Hustle. It's a famous Mark Cuban was one of the people that backed it up financially to do the documentary. And you see a lot of Chinese companies, they have the actual company in China, but they formed the entity and everything in the Cayman Islands, and then they listed on the New York Stock Exchange or the NASDAQ, which is crazy. Like, how can they list it? The New York Stock Exchange is like a prestigious exchange, and NASDAQ these are listed, and you got all these like scams from China listing, and you can't, like, for example, me, I would love to go visit them physically, but this is China, and China is like locked down during COVID. You can't even go. So like these stocks of Chinese stocks are flying like at crazy levels, and they're not being shut down because like no one can go there and really investigate.
So is the primary way that you find possible scams is to sign up for these kind of quote newsletters or pump and dump type outfits that you've found earlier, and just wait for them to promote a particular stock? Is that the main way you find these?
That's one way. That's one way. And it's crazy. Today, I sent a message to my friends. I said, nobody texts me. Only nobody ever sends me any text. No one loves me except the pumpers. I get I get a lot of text messages. So I reverse engineered it, right? So like I Googled, for example, stock tips or get rich quick stock tips, or all this kind of language that people use that are desperate, and then that mention stock in there, the keywords, and you get these landing pages of email lists. So yeah, I subscribe to them, and I gladly put my phone number there, and they send me text messages, and you can see in the text message it says a paid disclaimer. We're compensated this amount of money, this amount of money for this amount of days. They give you their game plan because that's them covering themselves. So I think it's more or less legal for them to do it as long as they disclaim it in the bottom in fine print. And yeah, that's one way to find it. I have other things I look for too, like underwriters that are sketchy. I have a whole list of them. Red flags that pop up with the Twitter people, the same Twitter, like for example, the Twitter people that got arrested and get shut down by the SEC. This guy, the whole group. I don't even have to mention them. Everybody knows who they are. I was on them for the longest time. I had a like a bot on Discord. There's a chat program called Discord. You could put bots in the Discord, and I had all these pumpers, the bots, on their tweets. So every time they tweeted, I got a notification, and then I was shorted.
Oh, wow.
More or less.
Yeah. So when you went down to Colombia, were you short Flora Growth before you got there, or did you short it right after you found it?
That's a good question. So the thing is, I use a lot of technical indications myself. So I studied everything. That's one thing I got, like, from architecture. As an architect, you got to know a little bit about everything. It's like a conductor of a symphony, like a composer. So the stock was too strong. So like it was started out like a $3 IPO. And then when I was in Colombia, it was like it's in the upper teens. And then like when I was with the altercation with one of the execs at the site, that it reached the 20s. So the stock was too strong to short it. But I knew, it's the insiders, they're doing this it's a lockup play. So once they're running it up for the lockup, then once the shares get unlocked, they're going to start to sell. And also, there's a certain amount of extension I look for as part of my criteria, and volume fade, is looking at daily candles, etc., to determine what my entry is going to be. And at that point, it was as strong as ever, and it was I didn't short it like before I went, but I knew the end is near, the end is nigh. So because like it's like when you have that much strength in a stock, the way it was going parabolic over a period of days, the blow off top is set in eventually, so the blow off top, once I got out from the site and I flew back to Puerto Rico, it already cracked. And then once it cracked, I put my short in. And So, and I shorted it ahead of so I shorted it ahead of the big announcement of the report as well.
So how difficult is it to find shares available to short, and how often do the borrowing fees, how much do they vary, and do they are they significant enough to make you not short a particular stock?
Yeah. So the borrow fee. So for Flora Growth, it was doable. There was shares available to short. It was okay. Now it all depends on float. If it's a micro float, a low float, for example, for me, I look for 3 million float and up. 5 million float to 10 million float. I like 10 to 20 million float is like it's almost headache free for me if I do everything I'm supposed to do. So it depends on float. So if something is low float, 3 million float or less, or micro float, less than a million shares, then yeah, borrows are going to be highly likely to be very expensive and almost not worth it because the risk reward is just not there. Because anybody can squeeze a low float, a 600,000 share float, just one or two players. And there's a lot of nefarious people in the stock market. That's one thing I realized right away, almost instantly, is like there's a lot of greedy, smart people in the market that are crooked. So like someone can actually take up the float, and they don't even have to report. If they get rid of it the same day, they don't have to report as an insider buy because they didn't hold it overnight. But if they hold overnight, then it becomes tricky. Then they have to report to the SEC, and there's a lot of games being played with that. But like, yeah, so it's just not worth it to short a really low float or micro float stock less than 3 million, less than 2 million, because the borrow costs are going to be astronomical. The locate cost to locate the share is going to be a lot, and it's going to likely to squeeze against you tremendously.
Hmm. Can you give us a range of interest rates that borrowers have to pay annually, shorting, say, a stock maybe on the New York Stock Exchange or NASDAQ versus some of these small float stocks on the bulletin board that you short? What typically can we expect?
Okay, that's a good question. So what I mentioned was locate costs. So in order to get the shares these days, you have to have a certain broker, a short selling specific broker, and you have to locate the shares. You have to request it on their platform. I use a platform called DOS. You locate the shares. That costs money, and they change prices intraday. Now that's the borrow cost to swing it. That's a separate cost. So you have an additional cost of the borrow cost. And these days, in a bear market or a bearish market with more short sellers involved, it's all based on supply and demand. So the more short sellers that want it, the more expensive it's going to be. And for example, I use Interactive Brokers just to monitor the borrow costs, because these brokers, a lot of times, they don't even have that accessible. You have to call them up and ask, what is the borrow cost? So you're almost shorting it blind. So like my borrow costs, I have a rule, like on Interactive Brokers, if I see a 200% or more borrow fee percentage, I don't short it because that indicates the demand for that short. It's almost like an intraday short interest indicator, watching that fee rate. And, I don't do to calculate it. There's a calculation there. You can calculate how much you're going to pay per day or per year or per month. But I just, and I used to do that. But now what I do is I just make a flat rule, because trading is very complicated. You got so much to do that I just make a rule. I said, oh, if it's over 200% fee rate on Interactive Brokers, I'm going to try my best not to short it, or I'll short it only early in the day, or certain time periods in the day. And after 11 a.m. Eastern, I don't put on a new trade. I leave it alone.
So does the interest rate that is charged to short a stock, does that change day after day? So if you enter a position and you say, hey, that this short interest rate seems reasonable, and then a day or two later they jack it up on you, does that happen, and how often?
When I first started in 2020 and 2021, it used to be like that. It used to be a lot slower. Like the interest rate, the borrow fee rate would go up very gradually over a slower period of time. Now it's like 2 or 3 times per day they update it. And, I have multiple brokers. So I have like a Slack and I chat with my broker. I ask them specifically, what's the borrow rate? What's the borrow rate? and I compare the borrow rates with which each broker. So, okay, this broker said 100%. This one said 150%. Interactive broker says 200%. Now I got to feel, and then like I'll re-ask the question later in the day, and yeah, sometimes it'll go from like 100%, or let's say 50% or whatever, and it'll go to like 1,000%. You know, it will go 500, 600. It increase like tremendously, and so like that indicates, and a lot of times that'll be before the squeeze. So that's why I ask a few times, because if I'm in a trade, I'll ask, and I'm concerned that the short squeeze is forming on the chart. If it's consolidating at a strong level, I'll ask the broker. I'll keep asking them. And then like if I see, for example, once last year, I remember I shorted a stock. I forgot the ticker, but let's say it was like a 20% fee rate. Then all of a sudden I asked the broker, and he said 200%. And I checked IB. All of a sudden it went to 400%. And I got out of the trade, and the trade about an hour later, it had a massive squeeze. So that indicates like shorts, the demand for the short is compiling, you know, and it's like it's going to combust, you know, so eventually. So it's a sign, it's an indicator in a way.
Mm-hmm. How often did you find scams in the recent bull market, and have they decreased materially in the current bear market?
You know, this is the scam thing is a problem. You know, for example, I have a whole list of them right here. You can't see it, but like I have a paid pump list. There's probably like 30 of them there. There's a Chinese pump list. There's probably about 20 of them there. You know, so, and that's just what I'm focusing on. But there's a lot of scams in the listed land, especially with small caps. And you know, that's just the way it is. You know, it's the SEC doesn't have enough energy, or doesn't have enough manpower to deal with it. And, you know, it's a big, see, now we have more people in the market more than ever, because of Robinhood in 2020. And like everybody, you know, knows about trading now. So yeah, there's a lot of chaos, you know, and that's just part of it.
Did you short any of the meme stocks during their periodic pumps?
So I did, and actually I shorted the sympathies for the most part. The sympathy plays are usually easier plays, easier setups than the actual head. They call it the head of the snake.
What's that? What is a sympathy play?
A sympathy play is something that follows like the shiny object that everybody's going for, like let's say GME, GameStop. Mm-hmm. And the sympathy play, I remember there was a stock called SLGG. It's a gaming company in the small cap land. It was probably trading at $2. Yeah, I think it was like $2. And all of a sudden, you know, since it's a gaming company, it's in the same sector, and it's a cheaper stock than GME. GME is, let's say, is at $200. People are looking for something like GME, GameStop. So they go for SLGG, and SLGG at the time, Brian Cohen bought GameStop, you know, and he posted something on Twitter, like a frog emoji and an ice cream emoji, a frog and an ice cream. And at the time, this is the crazy market of 2021. It was insane. And me coming in with like a logical mindset of like architecture and stuff, this was like, oh, this is like the weakest thing ever. No one, you know, who's going to buy that ice cream emoji and a frog emoji? And then so people, the crowd came up with all over the message board saying, oh, so the frog means, so the CEO of SLGG, first of all, it's a gaming company, and the CEO worked for this thing called Frog Construction or something. So the frog relates to that. And the CEO of SLGG, back in 1999, she worked at McDonald's. On her LinkedIn, it says she worked at McDonald's. And so that McDonald's serves soft serve ice cream. So frog emoji, frog construction, ice cream emoji, McDonald's soft serve ice cream. Ryan Cohen is sending us this thing because he can't blatantly say it to pump it because that's illegal. So obviously, so the crowd, this was all over Twitter, all over the message boards. And I'm like, oh, I'm going to bet against that for sure. This is ridiculous. And the stock squeeze like kept going, and it wasn't just squeeze. This is just momentum buyers, like nonstop. And like the stock went from $2 to like $11 in like a couple of days. And I was trying to hold it, you know, with this. It was terrible. It was one of my first big losses. This was early on. So that, you know, early on, I couldn't afford big losses, but this was one. And I came back from it, you know, strong because I made improvements. I learned my lesson the hard way, never to go against the crowd like that, no matter what, even no matter how ridiculous it seems. But that was the market. So that's a sympathy play. That's a sympathy play. So the sympathies never go as crazy as the head of the snake. They have less firepower. So technically they're the easier ones, but at the same time, you still got to trade it. You got to put in all your effort to trade it the right way.
I remember at the start of the GameStop squeeze, the reported short interest was over 100% of the float. Can you explain to us how is this possible?
So first of all, I don't understand that completely, but that means that from what I understand is there's a lot of short sellers in there. So someone told me a while back, and I don't know if it's true or not, but it says like short seller can count as part of that. So like, I really don't understand. No, it's a mind. But when you see that kind of short interest, you want to stay away from it. And so you had like a hedge fund. I think it was Melvin Capital. They were just too cocky and too they went all in. They blew up. You short more shares than what's available out there. So I think what it is that brokers and short seller and whoever's lending out the shares can lend it out before they reserve the share or find the borrow, and then within 2 days they have 2 days to actually find it, so they can lend out more than what's actually available. And then after a couple of days or whenever they update that, it's going to cause forced buy-ins and the stock's in a squeeze. So it's crazy. So it's something, it's like you don't really understand fully, because like who knows what the clearing firms are doing, or who knows what broker is doing that. Is it naked shorting? Like, what is it? So it's just a very confusing scenario, but it's just like, you can never go all in no matter how confident you are, or, when you see a high short interest, it's usually you got to stay away. You got to be on guard.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
From your research, were the meme stocks an organized pump by a few instigators like you see in penny stocks? Or was it really the masses organically coming together to extract revenge on those evil hedge funds and market makers?
Everybody needs a scapegoat, right? So whoever was really pulling the strings, no one really knows, but like is using the crowd as a scapegoat. Oh yeah, let's put, it's nice to believe that, but like in actuality, like what is it? So there's, in the market, we got nefarious players involved. So somebody probably orchestrated that and used the crowd as an excuse, as a facade. And like people like to believe a story, so of course people are going to say, oh, down with the man, I'm going to stick it to the man or whatever. Like they don't really understand what's going on. But, some people really profited off that it was a big liquidation event. And during that period, people had like money from stimulus checks, from unemployment, from all types of benefits, and people staying at home. So this is like something for them to do, and it's like money going from one hand to another, and it was orchestrated, in my opinion. It's just like, yeah, I don't think it was the little guy trying to beat the big guy, and like, yeah, that's just a story. But there was another bigger thing going on.
I'd like to transition to the topic of short squeezes. What are the mechanics of short squeezes? And are the shorts really forced to cover, even when their position sizes are a small percentage of their entire portfolio and they have plenty of reserve cash on hand?
Okay, there's several things that go on with short squeezes. So sometimes you could have a lot of space in your account to absorb the squeeze and everything, but the broker calls back the shares. They close the position out on you because they don't like there's a lot of ways a short squeeze can happen, So one way is the float. So the float that's traded, there's too many shorts in it. And then you have buyers that come in and buy as well. And it forces the stock to go up. And the pain threshold of those short sellers causes them to get out of the trade. And it just keeps going higher temporarily, like in a parabolic move. Now, brokers will do buy-ins. Like, let's say they can do buy-ins whenever. So let's say if I'm short overnight a stock and everything is going good, it's within my risk, it's everything. In the morning, if the broker wants, they can call back the shares as a buy-in. Let's say it's that we have this thing called the T+2. So, they can lend out the shares and they have 2 days to find the shares somewhere to cover the borrow. And sometimes they can't. So they do buy-ins to meet that requirement. So that's one way, and that can ignite a squeeze depending on the float, because the float is tied to supply and demand. So if the supply is low and the demand out supersedes that, the demand is higher than the supply, it's going to cause a squeeze. And then you have a buy-in from the broker that's going to cause more squeeze. And then let's say it starts to sellers in it to their pain threshold or their stop loss, and it breaks out. And then you have momentum buyers coming in saying, oh, okay, it's a breakout. It broke out the daily resistance, whatever, or whatever resistance level they're looking at. And then they jump in and now it causes super squeeze. And the lower we see a lot of these low floats, these micro floats that are less than $1 million, less than 2 million, less than 3 million, like I mentioned earlier, they're the ones that go insane. They can go, I've seen them over the years. I've seen the biggest one I saw, I think was, went from like $10 to 2,500. That was last year. There was GameStop, but GameStop wasn't a micro float or a low float, but that one was the first one to have a lot of volume.
Do you know the story behind HKD? I mean, what triggered that whole run there? I've never seen anything quite like it. And did you or anyone else try to short HKD and were successful at being able to hold the shares and not being forced to buy back in?
So see, HKD, from what I understand, all my colleagues and friends that are short seller traders or good traders in general, the conclusion is that it was pretty much impossible to win on it, because if you hold it, you're going to have a buy-in from the broker. And the borrow fee rate, I was monitoring it the whole time. It was over 1,000%. So even if you hold it overnight and the broker doesn't buy it in, you're still going to lose on the borrow cost because it's so expensive. And then on top of that, I found out recently that there was ghost fees attached to it. So that when you close the position out, it didn't settle with the clearing firm or anything. So like it just kept the fees just kept accumulating. So these are the risks with short selling. So HKD, going over it from the beginning. So it is a Chinese stock. It was based out of the Cayman Islands. It had a parent company, AMTD, is listed on the New York. Both of them were listed on the New York Stock Exchange, which from my experience, this was one of the first New York Stock Exchange stocks from my experience, my personal experience, that I've seen and keeping it. I actually was planning a trip to go to the Cayman Islands and going there in person and exposing some. And so they were all listed on the NASDAQ. HKD was the first one that popped up. I'm like, wow, this is a New York Stock Exchange one. Insane. So it was just thinly traded. The float was under 1 million, and it just kept going higher day by day. It will pull back a little bit, go higher. And I think, some short sellers, I heard from my short seller friends, they just were hitting it massive. So short sellers, they get cocky, because like shorting is a higher percentage winning strategy than longing. And that means that, the confidence level of some short sellers with a lot of capital it can get ridiculous. So like some people are hitting this with size, even though they know it's a bad trade, and it just kept going higher little by little. The spread was very wide. And then within a week or two, you see it at $2,500. And no, I did not short it. I was watching it the whole time. There were, however, sympathy plays and other Chinese scam companies, because, of course, there's always going to be some sympathy. Someone is like the typical person that buys a sympathy is like, oh, HKD, a Chinese company, Cayman Islands. I got to look at other Chinese companies out of the Cayman Islands. Let me buy it. And there's really no reason to buy it other than it's Chinese HKDs went up so much. So like, let's try another one. The momentum buyer buys that one. So there were some that were not as thinly traded that I could short, as well as HKD's parent company, AMTD, which had a higher float. I forgot what the float was off the top of my head, but it was a decent amount float. I think it was at least 20 million or so, which gave me all the green lights to short it. And AMTD was the main sympathy to HKD. And I was able to short that one. So yeah, I can recall that one. But HK and AMTD. So when the float is bigger, the borrow fee there's less demand to short it, because like it can absorb, the float can absorb the demand. The supply is there to absorb the demand. So therefore the short fee, borrow fee rate's lower, the locate fees are lower. It's more manageable. So yeah, I went after AMTD, and it's clear in the filings and everything. It says everything in plain sight. AMTD is a parent company. They had a diagram there that showed HKD and AMTD and some other companies that AMTD owns based out of Cayman Islands. It's ridiculous. So like anything that's Chinese out of the Cayman Islands is most likely a scam. It's a shame though. Like as much as I do well on these, traders like myself do well on them. It's just a shame that I can always find something else to trade. I'll find another thing to trade, another instrument, another stock. I'll figure it out. I have confidence in my abilities. But like to see these scams go through from China into the US and take money, because they're the ones really getting rich off this, So I don't like seeing that.
Often when I see stocks to short, often the bulls argue that the short interest is so high it's going to squeeze, and the shorts are going to be forced to cover. But do you know of any service that gives daily updates to the interest and provides, say, a weighted average price that the shorts have shorted the stock? Because on a particular day, if the shorts are forced to cover, I mean, how do we know that new shorts with deeper pockets don't come in the very same day or the next day? And so the bulls are maybe falsely thinking that, that the shorts are the same shorts and then they're bleeding every day, rather than having new shorts come in to replace the old shorts. And therefore, they're not as panicked by the stock price going up. What are your thoughts on that?
Yeah, so there's just so many inefficiencies with the market. It's I always wondered, why isn't like float updated all the time? And float is really not updated that well. However, there is a service called Dilution Tracker that started recently, like a year and a half ago or so, and they've cleaned up the float game. I think they're getting float data from a source that's more reliable than anything else out there. And they also have a team that calculates the float based off of the latest filings and the outstanding shares, and they really nerd out with that. So they figure that out. However, yeah, the short interest, that's something that's lacking. Maybe in the near future, there's going to be a service similar that comes like to Dilution Tracker that comes out and figures that out. However, my secret sauce, which is not going to be secret anymore after this podcast, I use Interactive Brokers, the borrow fee rate, as a way to reverse engineer the short interest. So when the borrow fee rate increases an exponential amount, that means a demand for short sellers, because the Interactive Brokers data for that, it says on their website, it's an aggregate from a lot of different clearing firms. So if the clearing firms are lending out shorts and basing their borrow fees off of the demand of that, and Interactive Brokers aggregates all that together and comes up with a borrow fee for that. That, I think, in my opinion, and from my experience, it has been a reliable indicator up till now, up until there's something better. Because before we had this rush of new traders in the market, hedge funds and stuff had access to this because they have a lot of money. They can afford all this crazy, sophisticated data and stuff. But now with a lot of retail traders, as you can see, no one could see there in the podcast, but I have a big setup and I have a lot of tools that now retail short sellers like myself have access to. So in the future, yeah, I hope that there's better data for short sellers to get that short interest, and instead of figuring it out. Because if, for example, right now, without the way that I'm doing it with the borrow fee rate and all that, I have to rely on the candles, the 1 minute candles in the chart, whether how violent they go. So like if I see a parabolic action in the candles within a very short amount of time, that's indicating a squeeze. And a squeeze of I have to imagine, okay, who's getting squeezed in this? Is it a big short seller? Was there when I eyeball it with the volume candle, I see a 1 million share sell order or a 1 million buy order that forced a parabolic action. I'm like, okay, that's probably not a long. That's probably a short that's forced out of it. I imagine someone getting forced out. Or for example, in the afternoon and power hour, I know from firsthand experience, brokers will give you a call and be like, hey, you gotta wire in some money or else we're going to close you out. They usually do that at 3 p.m. and an hour before the close and an hour after the close, certain brokers.
Hmm. Now, they will ask you to wire more money in only if your account is in the red. But if they request or if they demand a buy-in, they make you buy it no matter what your account status is, right? So would these giant spikes be an indication more of a forced buy-in rather than somebody having a margin call?
Yes, exactly. So let's say at one of those checkpoints, you see a big spike happen. I'm like, okay, so a short seller got blown out. That's what happened. That's not buyers coming in and buying it. That's a short seller got blown out. And that's the first of the first, that's the first domino usually. So now there's going to be a sequence of those. Cause like once one that forces the price higher, and then who's next? You know, it's like, that's the thing. So it's like reading the chart pattern, reading the volume, reading the tape, so you're looking at the borrow fee rate percentage, looking at the short interest on Yahoo or whatever Wall Street Journal or whatever service you're using, because the short interest is only updated the first of the month and the 15th of the month. So you got to like put the puzzle together. So trading now is all about short selling is all about putting this puzzle and using this, like imagining who's getting squeezed. Was there a big short seller in this low float stock? It doesn't take much to move these stocks if you're a big short seller. That's why, I like to go for stocks that have bigger float, because then I don't have to worry about that as much. But yeah, it's about putting the puzzle together. And these days, the data and the tools is still relatively new. You know, we're still in like this new wild frontier of like retail short seller. We're still figuring it out. Cause like if you think about it, the whole digital age started in the 2000 or so. And so it's been 23 years, and only I would say the past 5 years or so have been the short selling world has been accessible to retail people, like myself.
Mm-hmm. So you mentioned some of the criteria that you use to short a stock. So what do you look for in your high probability setups? You've already picked out the scam stock. You've already checked out the float and the borrow interest and all that stuff. What do you look for on the charts to trigger a short? And then when do you cover?
Okay, so a few things. So I like to short sometimes, for example, midday parabolics. Some days, some stocks, let's say over a stock that's trending down for the year, and I already know about it because I've shorted it throughout the year. I already know, okay, this stock IPO'd last year. It's coming up of a 180-day lockup expiration. It's borderline scam. Let's say it's a stock based out of the Cayman Islands. This happens a lot. So they have a 180-day lockup expiration. And then all of a sudden, midday, you get this big spike, like around 200 days. So 20 days after the 180-day lockup, it starts to spike big. And that's a combination of people that were short before, because the stock was fading down for the 180 days for the most part. It IPO'd, and ever since then, it's just fading down. And so like I already, so I would look to short that on a significant move. And for example, I'll have some criteria to, stocks will pop on my radar when they hit like 20% on the scanner, and I won't short it, but I'll keep an eye on it. And now it's on my radar. Now I'm focused on it. And then let's say if it starts to go higher midday, like 40%, 50%, and the float is semi-diluted because of the 180, it's been 180 days. So the insiders, sometimes they get out at 90 days. So that's been diluted some more. And then also there's some stock options and stuff involved in the filings, you can see, where they have exercise prices that more people got out, more insiders, so that the float is bigger than what it was. That's like the sweet spot, like a 200-day or so, and the stock just goes up 50 to 100% for no reason intraday, and I'll look to short that intraday, and I'll cover at the end of the day or something like that, because I don't want to hold it overnight. So what I've done, I take my gains intraday for the most part. Sometimes of the year, if I'm traveling or so, I will put on a swing, but a swing short, but for the most part, I'll cover them intraday. So that's one example. I look for the 180-day lockup expirations. I like to read the news on biotechs, like on Fluffy News, for example. If there's animal testing news, or if there's like phase one, they have just like 5 or 6 patients they tested on, the stock goes over, let's say 80% or so. I look to get to trade it, because the biotechs, they all need, for the most part, they all need cash. They don't have a product that they're making money off of. And, so they need to pay the bills, and they have usually S3s, shelves ready to go, offerings ready to go, ATMs. And yeah, a lot of them have low institutional ownership. So like it's usually pretty clean fades for the most part.
Mm-hmm. So do you ever go long any stock?
Long. No, I have not. I have not gone long. So I have Apple in my IRA, I guess.
Okay.
But
Right,
no,
right.
I decided early on I was just gonna stick to shorting, and that's it. I tried, there's a couple longs I tried out here and there the past couple years just to get I told myself last year, like on January 1st, that was one of my New Year's resolutions. Like, I'm gonna go long. And I tried going long. I even forgot the ticker. I think my friend told me about it and I just got out. It was distracting me from shorting, so I just got out of it.
Great. I'd like to transition to psychology and kind of to wrap things up. What do you struggle with the most in trading?
What I struggle with the most, I would say just being stubborn is something because, with short selling. So one thing early on in my career, I always knew I was a stubborn person, and holding on with short selling, a lot of times you'll get rewarded for holding something and being stubborn with it. So it's just something that I've had to work on, and you work on it through discipline and through just making set rules. Time, like for example, I'll give myself a deadline to hold a stock. Okay, I'm not holding this stock overnight. I'm cutting this stock at this certain level, no matter what. I guess the main thing is yeah, stubborn. I'm just a stubborn person in general, and that's a good thing and a bad thing. For example, when I was in architecture, I would just I wouldn't go to sleep until the project was done. You know what I mean? That's a good way to be stubborn. Trading, I'm going to read the book until it's done. No matter how long it takes. It's good qualities to be stubborn with. But it's like when it comes to trading, it can hurt you if you're in a trade and you're being too stubborn.
Hmm. Just curious if you had any desires to create or join a short research group similar to Hindenburg Research, or are you busy enough and satisfied with your, trading your own account?
I'm satisfied trading my own account, and I already set up a bunch of goals for myself. And I'm going with my plan. So I have a good friend of mine in White Diamond Research, and that's the one I aligned with to do the Flora Growth short report. So
Hmm.
White Diamond Research is one of the most reputable short selling firms, and yeah, that's so I kind of work in a way as like a independent person with White Diamond and coming up with ideas. But yeah, I guess I've gone to the point in my career where I'm self-sufficient. I'm doing so well and achieving like my dreams. So I don't really feel, I'm not really looking to do that. However, in the beginning of my career, I used to always imagine while I was studying the pump and dumps and seeing these reports out and being out of graduate school, I was like, man, what if one day I could work for someone like it that does this research firm? That would be cool. That would be so cool. And, going and investigating companies and stuff. And, that was before. And then fast forward, I was able to do a lot of that on my own. So in a way, I kind of achieved that goal of mine. But it's
Right.
nothing's ever out of the question.
Uh-huh. Well, David, thanks for coming on Chat with Traders. It's great to have you on the show.
Thanks, Ian. Been a pleasure.
Yeah. How can our listeners get in touch with you?
Okay, they can get in touch with me through Twitter at @reverse_long. Also, through my podcast. Everything is on the YouTube page. There's like a little Discord group and stuff if you want to be part of that, or it's just free to join, share. It's a community, but just of like-minded people. I'm easy to reach, easy to talk to, very approachable. I think so. Yeah, feel free to reach out and listen to the podcast. Yeah, for sure. I have the Friendly Bear podcast as well.
Yes, I've listened to quite a few of your interviews and very informative. Definitely worth listening to.
Thanks, Ian.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
The speed at which losses are occurring is more important than the actual dollar amount. If you don't know how fast you can lose the $200 that you planned out, then it's irrelevant, because once a trader says, okay, I'm going to lose $200, and then it appears on their screen and it appears so fast, now they're in that shock. There's the shock that the loss is there, and then now there's the shock of the speed. And then you get frozen. I don't know what to do. And then they don't make any decision. That loss turns into 400, 600, 1,000, and plus.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Around 80% of day traders lose money over the course of a year, and about 95% of day traders ultimately lose money. Now, I don't know how accurate those statistics are, but hey, it came from ChatGPT. What do I know? Anyway, what matters is you. That maybe you are going through this right now. We're in episode 258. I'm Tessa, co-host of Chat with Traders, and I've gone through the difficult times and suffered through trading losses as many traders have experienced. So I'm dedicating this special episode to traders who are stuck at this very moment in their trading. Maybe you feel lost, frozen, or ashamed by your losses. Well, it's important and about time we make real space to talk and think and approach the topic of losses in a different, open, and honest way. Our guest today is Alexander Moreno. He comes at the perfect moment to help open that space and discussion and shares his journey with our host, Ian Cox. Alexander dedicated significant hours to books and market analysis and sought regular counsel from a seasoned trading mentor. After refining his abilities through months of paper trading, he ventured into live trading. The reaping of consistent profits bolstered his confidence and led him to trade full-time for a living. However, the unforeseen market turbulence in 2008 unleashed his psychological struggles, leading to impulsive trading and ultimately to homelessness. Through this harrowing experience, it granted him invaluable insights that he now imparts to fellow traders everywhere. This is an eye-opening chat that can be a game changer for us traders in terms of how we think and feel about losses, and gives another perspective on managing the risks so that we can survive the trading game long enough to learn and improve through experience and eventually thrive. Just a quick reminder, this is not financial advice. The purpose of everything we do in Chat with Traders is to share. Now, without further delay, ladies and gentlemen, please welcome our guest, Alexander Moreno, originally from Queens, New York.
Alexander, welcome to Chat with Traders.
Thank you so much, Ian. I greatly appreciate it, Tessa, and thank you for everyone on the team.
So take us back, way back, to a little bit about your background and how you first got into trading.
It all started, I'm born and raised in New York. I didn't really understand what the stock market was, never heard of it. I knew it was in New York. And my first introduction to the stock market was when I went to the bank and they stopped me and said, would you like to invest in a mutual fund or a fund? And I said, sure. I didn't know anything about it. They sat me down, told me what the percentage return that they were having. And if I was interested, I never did anything like that. So I gave it a shot. And then I was always excited to get the statements. And when they came, the money wasn't really moving that much. So I kept kind of waiting and it kept just being very stagnant and just lost. And I eventually closed it. And I said, okay, this was here for this long. I would like to learn how to grow it.
What years was that?
This was in my college years. I didn't pick up trading kind of going forward with it until a little bit after that, but that's kind of like my first taste. And then I'm not really sure exactly where I started becoming very fascinated with learning how to trade. I just know that a lot of people have kind of different interests.
So as far as time frame, are we talking about early 2000s, 2010s, kind of
I think 2000s,
to get a backdrop?
Yeah, 2000.
Oh, so 2000. So this was after the .com crash or before?
Yeah, but before that, I wasn't in the market at that time. I really started learning how to trade and become interested in the market about 2006. That's when I really started going to Barnes and Nobles, reading books, trying to get videos, stuff that I still couldn't understand anything I was reading. I would read a lot about it. And then ironically in Barnes and Nobles, I met a man, his name is George, and he introduced me to my mentor. And he taught me about the market. He was a private trader and he didn't take on students that much. And he a lot of these private traders, as we know, Ian, they're very, very private. So I was able to interview with him and he took me on as a student. And that's how I started learning about trading. Options trader, private trader for about 30, maybe 40 years now.
I see. So you learned from books, you learned from him, and when did you first set up your first trading account?
So the mentorship started happening every 3 times a week for about an hour. And that's when I first started to understand a lot of the stuff that I was reading and looking at. And at the same time, what was now a waste of time. Like, okay, we're not going to pay attention to this. We're just going to focus on this. And the simplest stuff, which moving averages or candlesticks, became very, very clear. So now he started teaching me about options and just the overall market and how the stock market works. I eventually opened up a brokerage account, started paper trading, and I paper traded for about 6 to 8 months, and then went live. So I had good results paper trading, and then went live, and everything was going fine there. So that's kind of the steps that I took.
And so when you actually went live, did you feel that you were pretty well prepared and had a pretty good background in education, and you felt reasonably comfortable?
I did. And everything was good. Small lots, came down to having like a set core of stocks to always trade and to take a look and to place these trades. That way, when I met with my mentor, it's a little easier for him to review my trades. So he kind of knew what I was trading, and he knew what stocks I was going to place trades on potentially, and he knew when to review when we met. So it was even though there was a delay in the review of the trades, it was pretty on time.
So how were your early trades? How did they go? Did you
they did
make
well.
some early wins?
Did well. Yeah, they did well. You have your losing trades, especially at learning. You're gonna have losing trades, so you have your losses, but the winnings trades always made enough money to cover the losses. And the losses were small because I wasn't trading big lots. So I was trading one contract at a time in sim and practicing. And then eventually went live, and yeah, I felt perfectly fine. I wasn't afraid. I knew the stocks, how they moved, and I've been practicing with them, so I had a certain intimate relationship with them.
Uh-huh. And what types of stocks did you trade? And were you strictly a technical trader, or did you include fundamental analysis in that too?
Technically, a technical trader, that's what I focused on. Not too much fundamentals. We're focusing on what the stock is doing now, what price, and what it could potentially do. And then we would use options to try and profit from those moves. So you can buy the stock, as we know, and profit from the fluctuations, or buy the options. And then there was the time frame. So at the beginning, I was a swing trader, which means that I would hold positions between 2 or 3 days and see what the stock does. A lot of the times, we're just kind of seeing what the stock is going to do, and it takes a long time. So the learning curve was fast because I had a mentor, but sometimes reviewing some of these trades took some time because we would be in them for a couple of days.
Mm-hmm. How long did this mentorship go on for? And sounds like you were profitable for some period of time. You
Yes.
kind of dream come true. You didn't suffer from early losses.
Well, it was in the beginning of 2007 and 2008 when we know what the stock market did. So eventually I went live, ended up opening up my office with a couple other traders in New York. And we were there trading with a little bit, let's say, not the best experience to what happened in 2008 and 2009. So when we look at the market, we see a lot of opportunity, but our inexperience doesn't allow us to capture that. So there was a gap between what was potentially there and what was being captured through our strategic trading.
Mm-hmm. And did your mentor experience something similar to you, or was he on traded something completely different and different strategies?
Oh, yeah. Well, he's a very advanced options trader. So a lot of the times the stuff that he's comfortable executing, I would not be comfortable executing for a few reasons. Number one, I didn't have the experience of how complex certain things can be, or I didn't have the capital. So we had to do things that's specific for your capital. And when that happens, then you have to have a different mindset, approach, and strategy. So a lot of the stuff that maybe other traders with bigger capital can do, a smaller trader can't. And so the things that we were able to try and capture on, it's a little different. And then sometimes being exposed to a volatile market so early in your trading career is actually bad, because you see stocks move a lot when it's not normal, like the markets we have today, or into 2023. They move a lot. So a stock that's been moving $5-7 is now moving 12-15. So when you're fresh into the market, these type of market environments, you start believing this is normal. And it can mess with you a little bit, because then you always believe that these are the type of profits that can potentially be made in the market all the time. As we know, the markets have different environments. And that's what a trader needs to go through, is to understand these different type of environments.
Mm-hmm. Were you trading full time as your primary source of income, or was trading an extra, kind of like gravy on the top, because you had other sources of income?
At that time, the way my life was, I was concentrating only on trading. And actually, this is a funny story, because when I first started, they say you have to be dedicated, you have to be determined. So I was printing out so many charts again that my recycle bags were like 3 or 4 of just shredded paper. I was going through shredders like crazy. I always buy a better shredder and just print out the charts and just look and analyze and just really learn and try and take in what my mentor was teaching me, and then applying it on my own. So when all this started happening, I went all in, and it has its benefits and it has its drawbacks. And the drawbacks is trading is very isolating, which means that you can make a lot of mistakes, especially when it comes to trading live, and you don't know how to react to it. So you get introduced to how to make a decision, but when you're trying to fix a decision, it's something that you get paralyzed on because you're always thinking, is it the best decision? So you don't know your options. So losses kind of start lingering. Is this the best option? Is this not the best option? What can I do? And once again, that's building the experience of knowing I'm going to make a decision. This is the best decision currently, but it's not always the perfect decision. You're not looking for the perfect decision. You're looking for a good decision.
Mm-hmm. Okay, so you were trading full time as your primary source of income. Were you aware, or did you calculate the annual percentage rate that you needed from the markets to pay your bills?
This was something that I did not really pinpoint. One of the things that was happening was my personal expenses and my office expenses were something that I believe I was able to take from the market. But it wasn't so much of how much I was able to pull out, it was the execution of it. So a lot of the times when I tell traders my personal story, how I ended up being passionate about risk management, is going through all that, something triggered where I started looking at the market in a different way. And a lot of mistakes started happening. So I know we spoke about it, Ian, that I went back on trading stocks, ended up homeless, living in my car. My credit cards maxed out, my credit completely destroyed because of my irresponsible and reckless decisions that I made. Now, it wasn't always this way. And that's why I love the fact that we spoke about the one contract and kind of taking it slow. Somewhere along the line, everything kind of got triggered and started placing aggressive bets in the market.
Mm-hmm. Tell us a little bit more about how you went from some small early losses that were increasing in frequency to homelessness. I mean, what happened to your trading between then and before you became homeless?
Well, the trading took on a different meaning because with the zigzags that we currently have, that's exactly what was happening in 2008 and 2009. So you had a profit, and then all of a sudden it disappeared. The losses is something that we don't talk about a lot, is the speed at which a loss can occur. So when the markets turn very volatile, the speed at the losses appear on your screen are so fast and intimidating, it's almost in a shock. And then a few minutes later, it can be a profit. So this is something that just started happening on the opposite side, on the competitive side. Well, if all these zigzags are happening, then I can make more and more money with these type of positions. And the inexperience is what really led me to lose a lot of money in the market, because I would not understand when I should exit a trade for a loss, and then would get bigger and bigger and bigger.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So what you learned earlier with your mentor and in the books, did you feel that those lessons were better applied during calmer market conditions? Was 2008 a type of market where what you learned didn't apply very well? Or was it the psychology of applying what you learned previously?
The second part, and the psychology of applying that, it is beyond two different distinctions. I can't express enough to any listener out there, any new trader, that the application of what you're learning is key, is by far the most important part. And when you're learning something, you're going to make mistakes. And in the market, those mistakes cost money. So you want to minimize how much a lesson is going to cost. So you have two traders, trader A and trader B, enter the same exact trade for the same exact reasons. And the end result is a loss. Trader A just bought one share, for example, so they're going to lose very, very small to learn that lesson. And trader B, who just got aggressive in his learning, lost, let's say, $500. For the same exact lesson, these two traders are going to talk about why they no longer want to enter a trade like this. One of them, it cost them, let's say, $10, $20, and the other one cost them $500. These are the lessons that you have to learn as a trader. The lessons do not have to be expensive. You will dictate how expensive that lesson is.
Did you share these results with your mentor? And if so, did he have any advice for you?
That's a beautiful question, because my mentor is actually very, very conservative. And he did not teach me to trade aggressively. Now, yes, in certain moments in the market, you do want to be aggressive, and that also takes experience and training. So you can get aggressive and add on more risk without being reckless, and that's super important. So if you're risking an X amount, that's perfectly fine. And if you want to add on a little bit more risk, that's also fine, but it doesn't have to be reckless and irresponsible, because risk management is not a numbers thing. Risk management is an emotional state that a trader's in when they're about to place that trade. So that's why risk management should not be taught in numbers. It should be taught more on an emotional level, on why this trader is placing this trade emotionally, to understand that your emotions are your best friend in the market. And we get taught that you should trade without emotions, but your emotions are always going to be tied in with when it comes to risk, because if you want to increase the stakes with anything and you bet, you already want to perform. You already don't want to be wrong. You don't want to lose. And in the market, when it comes to a trade, you have to be very, very willing to say, hey, I have to close this trade, and not view it as a loss. It's just an action you're going to take. And it's an action that you're going to need to take because you have the strength to take a loss and move on.
Were you affected by revenge trading?
Revenge trading is something that I think is a word that's could be used to being competitive too, because revenge trading, you could be down in the day, and then if you call it revenge trading, then you come back from those losses and now you're in positive territory. So what is revenge trading versus continuing to trade in a strategic manner? So everything in the market has to be very strategic, and that's what new traders need to understand, that you have to know why you're placing these trades. But in an interesting follow-up for that question is, let's say you're going to place 15 trades and you say, okay, this one's revenge trading, this one's ego trading, this one was boredom trading. They all have reasons why you entered the market. Now, if all those trades become losses and you still follow your risk management plan, you're fine. So it doesn't matter what, when, or how you trade, as long as you have a risk management plan that accounts to, hey, these are the reasons I'm entering, but I could be wrong, and cap the losses, you're perfectly fine. So the reasons are not as big as the risk management part. And we focus a lot on the reason, and we take the emotional part about risk management, which should be opposite.
So what makes the psychological aspect of applying these rules so difficult? Is it because prior to making the trade, intellectually, you can agree like, oh yeah, I'll do this and I'll do that if these things happen, and you're fine and you're calm. But once you get caught up in the swell of emotions, do you feel like you're losing control of yourself to this wild emotional animal inside of yourself?
That could be a part of it, but it's the competitive part and the part that you want to believe that you can identify a moving target and where it's going, because the stock market is a moving target. So you're going to have to identify direction, price move, the time it will do it, and how it will do it. And you're placing money on that. You're placing a bet that you're going to be able to identify these 4 things. That is very, very challenging. So we have to understand it's almost like playing tag or dodgeball. Like, you're going to miss. And it's important to not get frustrated, because you also know what's normal in stock trading. So if you have to identify those 4 things, one of those 4 things you're going to miss. You might miss on all 4, and that's perfectly normal. So to be competitive and to be aware of what's normal in the stock market will always lead to traders breaking risk management, because they want to believe they can identify all 4. It's almost illogical to think something like that. You're going to be wrong, and you just want to make sure that the stock market is your opponent. So sometimes you can defeat your opponent, and sometimes the opponent defeats you. When the opponent defeats you, that has to be at the minimum loss possible. You have to minimize the damage.
I see. So how long was it from the time that you started to lose money until the time that you presumably blew up your account and became homeless?
Yes. And then it was about 6 months to a year. So with personal expenses and office expenses, losing money in the market, it really, really kind of like the perfect storm. It really went down pretty fast. And it was, once again, just placing irresponsible, reckless trades. Trading became like an addiction. So you overtraded. So you placed a tremendous amount of more trades than you should. All of them are not strategically based trades. And it's almost something that I just couldn't take control over. I don't know how to explain it, but after learning more and more what gamblers' addiction is, or compulsive gambling, I know now that that's what it was. When you revenge trade and you impulsive trade, you're entering and you're really touching on gambling, compulsive gambling. And we want to make sure that the retail trader understands this. That's why I help the retail trader. All the help I provide for risk management is free, because I know what it is to go through that. And I know what it is to trade on your own and not have anybody to talk to. A lot of traders trade on their own, which is extremely bad. And I know there's a program to have accountability partners. And that's crucial, because you don't know how you're going to react to this. This is something that's very, very stimulating in many different ways, and we don't understand that. And when people call it gambling, it is if you treat it that way. But we have to be more strategic.
So reflecting back upon that time, were there any clues that you were aware of, or your friends or family were aware about you, that indicated that you had tendency toward gambling, drugs, I don't know, alcohol, video games, anything that can be very addicting. Did you have those tendencies beforehand?
No, because sometimes the word addicting is also can be translated into obsession or passion. And when I started doing this trading and I went on my journey, I isolated from everybody. I wanted to concentrate this. I didn't go out. There was never any of drinking or anything like that. It was just really just learning. I wouldn't leave my house for days, just looking at the stocks and learning this. So when it became something that I didn't understand what I was doing, I wasn't really talking to anybody about this. So I'm very private when it comes to certain things when I want to achieve certain goals. And this was one of them. So I just wanted to kind of get the end result. So I was a workaholic, working on this, working. But the reality was I was going under, and I didn't know how else to tell anybody because it was, well, he's a workaholic. He's just concentrating, as to me hiding all these results that were happening and knowing that I had a timer on my finances and that this didn't look good. So trading became very, very pressure based, and you're not able to perform your best that way because you're not going to take profits when you can, because you say, well, this profit is not big enough to cover some of the expenses that I have. So you may start placing irresponsible or reckless trades, and that will mess with the execution of your trades.
So your need for this income did pressure you into taking trades that you shouldn't have taken and or holding on to positions longer than you should have?
Correct. Yes. Mm-hmm. And at the same time, turning it once again to an addiction. So it goes into being competitive, learning, addiction. It also hits certain points where, is this even possible? Can someone make this amount of money in this short period of time? And you place these aggressive trades to kind of find out, is this possible? When it does, it kind of triggers something else inside you that you may want that all the time. So it goes from trading to gambling to excitement. And this is what you have to really pay attention to as a trader. Because if you're starting to feel these things, understand that this can trigger something that you may need help with. And this is why risk management or risk managers are at these prop firms and everywhere, because a trader loses control. They have the ability to go and close all those trades out for the trader. The retail trader doesn't. So it's important to talk about risk management, not so much in a linear way, to give the retail trader actionable steps that I'm by myself. What can I do to slow down the speed at which losses are occurring? And that's something that, Ian, is not talked about in the industry. And anytime that it talks about risk management, the speed at which losses are occurring is more important than the actual dollar amount. Because if you don't know how fast you can lose the $200 that you planned out, then it's irrelevant. Because once a trader says, okay, I'm going to lose $200, and then it appears on their screen and it appears so fast, now they're in that shock. So there's two types of shock. There's the shock that the loss is there, and then now there's the shock of the speed. And then you get frozen. I don't know what to do. What should I do? I'm by myself. And then they don't make any decision. That loss turns into 400, 600, 1,000 and plus. So the speed at which losses are occurring, here are the three things that you can do. You have to close something. You have to close something. You have to take action. You have to be able to identify a losing trade. What is your criteria to say, hey, this is now a losing trade? It met the criteria for me to exit. And the dollar amount is going to be attached to that, but there's also the speed. What occurrence needs to happen for me to close out a losing trade, and how fast can that happen? Is it technical? Is it price? Is it indicators? Whatever your strategy, but you cannot place a trade not knowing how fast this can turn into a losing trade. That's more important than the dollar value.
I see. So this process, when you're losing all this money, did it feel lonely? And when did you actually hit rock bottom?
It is. I smile about it now because I have the strength to tell everybody. But there was a very, very key moment. Remember, I isolated myself from everybody. Didn't want to go out. I'm a workaholic, but at this time, I really have no money to be social or to meet with friends for anything. And it was time. It was time. Rent was backed up, credit card, everything was overdue, everything was just a mess. And I think it was time. I was like, you know what? They need to know the truth. My best friends, they need to know the truth. So we went out one time and we were all there talking. And they asked me, how's your stock trading stuff going? I'm like, right away, Ian, this is my response. I lost everything. And we're sitting together, 5 or 6 of us, just hanging out, catching up. And they're like, one of my friends is like, what do you mean you lost everything? I was like, I lost everything. And it's like, all the money I have is the money I have in my pocket.
Wow.
That's it. And I get emotional about that point of the story, not because of the pain and not because of the experience, because what I'm about to tell you is the biggest like breath of fresh air that happened in that moment. And that's, I didn't have to lie no more. I was like, I felt like such a weight come off my back. And they were like, what do you mean lost everything? I was like, I lost everything. I have the only money I have in my pocket and stuff like that. And I felt free again. And from that day, I'll learn I'll never be broke again in my life. I just felt free again. I felt free. I was like, okay, it's time to work. It's time to work. It's time to move forward. And one of the most beautiful things that another best friend of mine told me, he said, he said, he said, I never had that much money to lose. I've always been broke. so, so that made me laugh so much because it's true. And that's why I appreciate the opportunity to be a trader and to go to this, like this journey of making a better life, because someone never gets an opportunity to do that. And I want to take this moment right now to just say that I know that my story of losing everything, going bankrupt, and everything that we spoke about earlier is not above some of the real problems that everybody faces, like having a terminal illness, an amputee, a lot of the really, really big problems. I never want my story to be above any of that. Please, I just want to make sure that we just allow the retail trader to know that placing irresponsible, reckless trades has an end result. The addiction towards stock trading and turning stock trading into a gambling addiction, all that stuff has an end result. And some people weren't as lucky as me. I have to say I was lucky because I lost everything. I was single. I didn't have a wife or a child that I have, my beautiful son, Zakiel, and my beautiful wife, Lola.
Mm-hmm.
It's something that, I just want to say this. When I lost everything, my wife was with me.
Mm-hmm.
And it was interesting because I said, I could lose everything, but I can't lose her. And we're still here together after all this. So it's important. Wow. It's important to know that there are risks in the market, but the biggest risk in the market is you, the trader.
Mm-hmm. So how did you kind of rebuild yourself? I mean, what was the process of you starting over and kind of re-educating yourself, kind of resetting yourself? And how long was that?
That took many, many years. And because first of all, your credit gets destroyed for about 8 years, right? So now you can't really do much. So all these struggles, and fortunately, once again, we're here in the States where there's opportunity. So I didn't go into no addiction mode in the sense of God bless everybody with any addiction, drug addiction, alcohol. I didn't go that way. My thing was just straight. I have to get to work. I'm going to work wherever I got to work, as many hours I got to work, and just get through this. And it took many, many years. And the addiction to the stock market was always there, because every time I would save up a little bit money, I would put it into the stock market and continue this journey to be a trader. So everybody has a different journey, and we want to make sure that that there's one path that we all understand, is that it's going to take some time for you to learn. You have to go through different trading scenarios. You have to go through understanding your strategy intimately. Sometimes it's not going to work. Sometimes it works exponentially. Sometimes it's just kind of break even. And when you don't understand this as a trader, you put a lot of pressures on executing and performing in the market that doesn't allow you to make the best decisions. So it's more important that you come into the market with money that you can afford to lose, and really, really wanting to learn to trade, not just to place trades.
You mentioned in one of your recent videos that you have on YouTube that your current mindset is not built for stock trading. Could you expand on that a little bit?
Yes, because a lot of the stuff that we do for work gives us a paycheck. We can make mistakes. We can make a lot of mistakes. We could even learn on the job, and we still get paid. So we could take that for granted, knowing that we're not going to be our best or perform our best, or we don't need to perform our best in order to receive an income or a paycheck at the end of the week. When it comes to trading, you have to be very, very, very strategic. You have to know that you're going to take losses. You could have a losing week, a losing month, and you have to be able to sustain that mentally, emotionally, financially. More emotionally, because money means different things to everybody. And for us, it could mean helping our family members, more security, maybe giving back to the community. And it's something that you're going to put a lot of pressure on. And it's something you have to know that there are traders that trade only one stock. There are traders that just trade every 3 months. There are traders that trade every single day, maybe 5-6 times. So there's so many different styles. And for you to understand your style, you have to go through that learning curve. There's no, hey, this style is better, that style is better. You just have to kind of go through it. Like we spoke about, it's perfectly fine to go through it. You just have to minimize the losses when you're finding your way in this, in understanding your strategy or why you're placing a trade, and everything that goes through with the market environment, trading news, trading earnings, trading a bull market or a bear market.
And as part of this learning curve, do you advocate that new traders go through a paper trading for a while before they go live?
Yes, I do. But many traders don't want to trade paper trading because they don't feel that their emotions are attached, they're real, and that's perfectly fine. There's pros and cons to it. But when you're paper trading, can I identify my strategy is present? Can I identify it's time for me to throw to the end zone because the defense is playing this? Is it time for me to do X, Y, Z? That's what you practice in simulated trading, fake demo trading. Because once you go live, you're going to make mistakes, and it's perfectly fine. But if you can't identify when your strategy is present for you to place a trade, there's no reason to put live money for you to understand that. There's no reason for you to lose money in the market if you're just placing trades without any direction.
Do you know of a way what is the best way for us to train our emotions? Because that seems to be the biggest stumbling block, right?
It is. To train our emotions, you have to put in your reps. You have to go through your losses. And I like to help traders with 4 types of losses. There is, number 1 is a planned loss. Number 2 is a respectable loss. Number 3 is an embarrassing loss. And number 4 is a devastating loss. We have to be able to identify our losses. And the reason these 4 are there is because I want to talk about your planned loss is the one you calculate. It's okay, I want to lose $200 on this trade. You know that when the criteria for a losing trade is met, it's going to equate to $200. But the respectable loss is because a lot of times you hear new traders say, oh, I get stopped out and then trade goes for me. So a respectable loss would mean that you give your trade a little bit more leeway to see if it's going to work in your favor. So you have a $200 loss. Okay, you don't want to take it out. You still want to see, okay, maybe it could turn around because this is something that it's in my mind all the time. And you give it maybe another $100, right? I don't want to get too much into percentages, but that's the idea. That's the emotional part of training your mind. Okay, I don't want to close it out. I don't want to take a loss. I don't want to feel bad or have a low self-esteem or anything that goes how you identify or attach yourself to a losing trade, but you give it a little bit more leeway, and then maybe you can close it out. So you're still taking on risk, but not in a more emotional, responsible, not reckless way, but you still have to take action to close a losing trade.
Well, if we look at our trade and it's now turning into a potential respectable loss, are you advocating that we decide on the fly with our emotions, as we watch it manually? Or do we isn't it better just to set our stop losses wider?
The retail trader, the new trader, will not do it that way. That's why I want to make it more aware for where the real problem is. And the real problem is going through that emotion. If you go through those emotions enough, eventually you will say, maybe this rule is very important, because look what continues to happen. As opposed to forcing the rule. When we get forced upon a rule, we feel like our freedoms are taken away from it, and we want to have freedom of choice, especially expressing ourselves so creatively in the stock market. So we will not pay attention to the rule. So it's better to embrace where the problem is coming from and say, okay, how do you feel? How do you feel about this loss? Like, talk to me, write it out, write it in a journal, voice it, email yourself, whatever, really go through it, and maybe look at other numbers. What if this was this loss? What if this was an embarrassing loss, a devastating loss? Do imagery. Close your eyes and visualize yourself taking this loss. How would you feel? How would your account be? If you had to tell this story to your friends and family or another trader, go through those emotions. What would they say? What would they think about this? This is where the starting point of risk management is.
You've mentioned that categorizing. You mentioned about position size. If you're wrong, you won't get hurt. How do we define that, and how do we get enough skin in the game to care, but not too much?
That's all an emotional state, and that's all also part of your account. So you can get addicted to that also. And I'd rather someone get addicted to the process. That's more important. If you get addicted to the process, you always want to trade. You will see that traders who blow up their account will feel worse that they cannot trade. So we have to really approach risk management to ask yourself, you want to trade. You want to trade as long as you want to at least go through those emotions, whatever you're feeling. So don't hurt yourself enough where you can't trade. So you want to make sure that the position size is something you can go through all the fluctuations of the market, like the Fed meeting yesterday, how it went up and down. You need to go through that. How do you feel looking at your P&L go through, it was profitable and there was losses? And that's why some traders don't look at their P&L, because they have to find this out. So it's important that you give a trader all the choices and let them go through all the choices and emotions towards risk management, and let them tailor risk management to themselves to understand, okay, I can go on a losing streak. Peter Brandt, who's obviously one of the greatest traders to trade, and he says with 90% accuracy, he goes on a 10 to 15 trade losing streak. So when traders get into trading, not only do they not account for a losing trade, they don't account for a losing streak. Therefore, they don't place the proper bets on each trade. And one of the videos that I made is it's called block trading, where you place 15 trades and then you say, you know what's the worst case scenario? The worst case scenario is if you lose all 15 trades. Where is your account going to be? Where are you going to be emotionally? Can you handle that? Do you know which trades are going to be winner or losses? You don't. So it's more important that you look at risk management from all the areas that you don't want to.
So you mentioned block trading. Is the value of block trading such that we don't place so much emphasis on any one single trade, but are able to trade, many trades, consider them as a block, and then learn from that as a general lesson rather than getting traumatized by one trade?
It's kind of both. You're already going to get resistance. The mind's already going to not want to calculate the X amount of of money lost if you lose all 15 trades. So that's why when you think about the emotional part of risk management, you also have to find out how you evaluate your mistakes. And the reason I became a risk advocate, or really like a risk manager, because I wanted to make sure that people understand how to train themselves properly in your emotional part of risk management. And I got started because I was able to share my story with Terry Ijeoma, who has a trading academy, and she shared my story. We became very close, and I shared my story with her students. About at that time, she had like 200 students, and I was there talking about risk management. And it's a beautiful thing to be able to share my story, because a lot of people don't want to kind of show their losses. And here she is saying, you know what? Risk management can lead you down this path. We're going to teach you how to trade, but we also need to teach you about risk management. Now, risk management has become very, very dominating now because of the 2022 market. And you can really see that a lot of traders are not putting a lot of emphasis on risk management.
You've mentioned in the past that trade management, the art of trading, is actually more important than knowing when to enter and exit. So some of this stuff that you're talking about is part of trade management?
Yes. It's also, we're going to take a look at the retail trader doesn't know how to enter a trade yet. Maybe they don't have a mentor, they haven't gone to any forums, they don't really understand. So when you enter a trade, you have to be able to know that you have to be able to duplicate this. And if you're entering trades for an emotional reason, that's a trading system in itself. And we want to kind of be aware that we're trading emotionally or trading strategically. And it doesn't matter what you trade, when you trade, or how you trade. It'll always lead to making sure that the trader's psychology is not crossed a trigger to place an irresponsible or reckless bets. And if you're starting out, it's better. Let's say you have an account of $10,000, and a new trader is going to come in, and they're going to make mistakes, which means they're going to lose money. You're better off taking that $10,000 and breaking it up to, let's say, 5 accounts. Fund your account with $2,000. If anything happens, you know that that's your max loss. You don't have to rely on yourself and your emotionals and your training to kind of stop out and deal with losses. You already have a stop loss on your entire account. If you do anything reckless, all you're going to be able to lose is $2,000. Now, and you have 5 accounts. So if it takes you 4 months to blow the $2,000, then you already prolonged yourself that you're going to be in the market learning for almost a year and a half at that rate. And you can learn everything. You can trade as many stocks as you want. You can trade different events. You could trade earnings. You can trade the different cycles that the market goes through while you're learning your craft.
So the key is staying alive long enough to learn this process that's not just intellectual, but very emotional too, and learning to embrace your emotions, right?
Yes, because the market has 2 types of risks. There's a 1-to-1 risk ratio, which what we just talked about. If you take that risk and you just put it in your entire account, you could only lose $2,000. That same thought process can be done in a stock. So if you're going to buy a stock, let's say Apple, to make things easier, and you put $5,000 in Apple, all you can lose if unfortunately, let's just put stock XYZ. Let's not even put Apple. Stock XYZ, you put $5,000 and all you can lose is $5,000, right? If the company goes bankrupt, that's all you can lose. Then there's the partial risk. So we have the 1-to-1 risk we just spoke about, and we have the partial risk. The partial risk is if you have $15,000, you put it on XYZ and you say, you know what, if it goes to $10,000, I'm going to exit this trade and take a $5,000 loss, equivalent to the first example, but now it's a partial risk. Now you have to actively manage this trade. Then most of the time, traders think they're good at that, and they're not. And this loss turns to $8,000, $7,000. Your account gets lower and lower and lower. So you're better off, once again, at the very beginning, since you don't understand what you're not good at, just put in $5,000 in stock XYZ, and you know that's your max risk no matter what.
You've mentioned earlier about being in a flow state when making decisions. What is that, and how do we get there?
Being in a flow state is very different for everybody. And I know we talk about a lot about meditation, maybe visualization. One of the things that really helped me last year has been getting a trainer. And I have a trainer 3 times a week. So it really, really has helped me emotionally, mentally, spiritually. It's something that you have to learn to have a lot of self-care when you trade, because the market's there and it's always going to be there to maybe embarrass you, make you second guess your decisions, always think that there's a better decision. So you're always going to be in a mind state that you're not making the best decisions, or there was a better decision to be made, and you start chasing the better decision. When you start chasing a better decision, it's going to cost money because you're going to make mistakes trying to get to that better decision. So you want to be able to minimize and always have rules in place on how is it that you're going to navigate yourself when you're making a decision. Because you can feel bad that you didn't make enough money, right? And you could feel bad that you lost money. So now a trader is dealing with all these emotions. I made money, but I'm so frustrated. I'm not happy. I'm just very, very beyond myself because I didn't make as much as I could. And now you have losses and dealing with a losing streak or losing month. And now you're there. So you're dealing with these two types of emotions every single time you trade. It's going to be very frustrating, very taxing. You're going to build a lot of anxiety, and all this energy has to be released in order for you to have a clear mind. So journal, talk to other traders, maybe kind of get an accountability partner you can just run your emotions through it and kind of get balanced where you're doing these type of emotional exercises in a positive way.
Mm-hmm. You mentioned a trainer. What kind of trainer exactly?
I got a physical trainer, and I also got a boxing trainer. I did that for a little bit, and it was very, very helpful. It's good to have tangible goals outside of the stock market, because you can trade and put in many, many hours, especially at the beginning stages of your trading career, and not get paid. And you're going to feel a certain way about putting so many hours and not getting anything in return. This also pushes traders to place irresponsible, reckless trades, because if the market is not giving you something that you expect or want at the time you may need it or want it, then you're going to say, you know what, I'm going to place this trade and I'm going to make X amount of dollars because I need to get paid by the end of the month. And that's not the way the stock market works. So if you have something tangible that you can work on every single day, that you know that after 30 days, there's going to be something you can check off, a goal, something you're going to be proud of and be happy, that's going to help you a lot in trading, and it'll balance your psychology and your mindset and your mood. So you're not trading so much emotionally, and at least in the negative emotions where you can hurt yourself financially.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
What are a lot of the reasons for overtrading, and how do we avoid it? You mentioned emotions, getting caught up in the emotions and the addictions. Is there anything else?
The overtrading is easy to get into overtrading for many reasons, because you're looking at stocks move and you want to be smart about it, that you predicted that the stock went up or down, and that amplifies with having a lot of stocks to trade. So we have to also identify that there are different styles to getting into overtrading. So if you're a trader that it's always looking for stocks to trade, then if the stocks are moving a lot, you might end up with a lot of positions just because you want to capture each move. Now, if you're a trader that has like a universe of stocks, let's say 12, 15 stocks, and then you're just excited to place trades because you enjoy trading those stocks, you may overtrade and end up with a lot of positions that way. So we want to make sure that the overtrading, is it for excitement? Is it over trading because you're learning your strategy? Is this done in real or fake account? Because if your strategy went off and got triggered 15 times, that might not be over trading for one trader, and that might be over trading for another trader. So we want to make sure that every time you place a trade, you're learning something. Either you're learning something about your strategy, you're learning something about the market, you're learning something about yourself and how you're dealing with all these emotions and the way the market's moving, the way you're interacting with your P&L, the way you're interacting with journaling, and everything that goes on in this universe with trading.
Mm-hmm. So how would you differentiate? What are the common practices of a professional trader compared to novice traders? What habits are different between them?
The professional trader, and this is a good friend of mine, Todd, has always said this. He says, I don't know anything. I don't know what's going on. I don't know what's going to happen. At the very beginning, I didn't understand that. And you can talk to another trader, and I want everyone to truly understand when you're beginning your trading journey, the right answer to your trades is, I don't know. That's the right answer.
Mm-hmm.
And we actually go opposite of that. We want to say, I know this, I know that. What you do know when you place a trade is that it met the criteria for you to enter a trade. It met the criteria for you to bet a certain amount on that opportunity to see if that trade works. What you don't know is the result. So you should have more confidence in saying, hey, do you think Tesla's going to go up? Oh, I'm bullish on Tesla. I don't know, but I'm bullish on Tesla, but I don't know. That's it. That's a perfectly good, solid answer for all your trades. You don't need to explain your trades to anybody because their reasons for trading are very different from you. If they're long Tesla and you're not, that's perfectly fine. That's perfectly fine. Even if you're trading right next to each other. If one trader's short and the other one's long at the same exact moment, that's perfectly fine. As long as each trader has entered their trade based on the strategy that they want to implement with solid risk management plans, it's perfectly fine. It's perfectly fine.
Great. I'd like to wrap things up with some psychology and curious, what do you struggle with most in trading?
I love to trade. That's one of the things that it's super, it's just exciting. It's super entertaining. It's something engaging, but we want to make sure that we stop trading more than we continue to trade, because you always want to engage into the market in a strategic manner. So when professionals trade and don't trade, we want to make sure that there's a lot of strategies out there. Like some traders only trade earnings. That's the only time they trade. So they don't trade for 3 months. Some traders only place 5 or 6 trades a year, some 5 or 6 trades a month, maybe 1 trade a week. Once the results, because all these strategies that I just mentioned have earned traders millions and millions of dollars. And they've had to go through their learning curve to understanding when not to trade. And when not to trade is going to cost you money also. So all these lessons, just make sure you minimize the cost so you can find out who you want to be as a trader, what you want to be as a trader. And if you're like a creative person that doesn't want to be in front of their screens, then you're going to trade differently than someone that wants to be in front of their screen. So those strategies cannot mix and match.
I see. So it sounds like the key importance here is getting to understand yourself, what kind of trader you resonate with, and pick your strategy and then follow that, like specialize.
Yes, because a creative person, a person who plays music, and there's a lot of people who have done very well in the stock market, they just don't trade. They do other things outside of the market. It's important to read about them in the market wizards. You'll see that a lot of traders do a lot of great things outside of the market because that's what they really enjoy doing, helping people, creating art, music, very artistic, very fast. They do not want to sit in front of a screen. So you can't force yourself to be in front of the screens if that's not your natural tendencies. But you can be very, very profitable in the market if you have $100,000 account and you make $20,000 at the end of the year. That's a 20% return on your money. That's amazing. but that's not going to provide a life for you in certain areas. But you're taking a skill set, a lifelong skill set, and doing something that you're supposed to do is grow your money and do it in a slow manner. So don't press so much on making trading your full time, because the idea is to have multiple streams of income. And you see a lot of multimillionaires don't just do one thing. They do have money in the stock market, but they have a company, they'll have real estate, they have other streams of income. So let's make sure that we understand trading can be one source of income, but don't be attached to it to where you feel really bad about the person that you're becoming.
I see. So have you been active trading in the market in the last year?
Yes. Most of the time I tend to be a bearish trader. So I'm more of the strategy that I'm building and have built tends to be better performing when the markets go down. So a lot of the times that I'll have certain zones in place, and different zones have different, let's say, strength and support and resistance to them. So we kind of wait for how the strategy performs during certain market waves. And sometimes it exponentially performs. Yesterday, it did well. And then today, obviously, gave a lot of the gains back. But kind of like the frequency to get more in tune on when to put on more risk and when not to put on more risk.
Mm-hmm. So are you looking to short stocks then at once it hits certain resistance levels, or do you specialize in any particular sector?
No, that's a good question, because at the beginning we spoke about just looking at too many stocks and you become competitive, and then you just end up with too many positions in your portfolio, and then your portfolio has too much risk and it's moving too fast. Then we started just focusing on, for personality reasons, on just very, very few stocks, because personality, you can just trade one stock and that's perfectly fine. So don't get caught up into wanting to trade so many stocks. If that's not your personality, just trade one stock, because that's a style in itself also. And just focusing on the SPX, that's something that keeps me happy at the same time. Risk reverse, SPY, which is the same thing, and a little slower. But just really focusing on that to making sure like the other trading errors that are personalized are not active.
Mm-hmm. So are you more of a swing trader or day trader?
It's a combination of both. It just kind of depends on what the market is doing, and I'll have a duration for a trade. If the market made a move where the price is time to take some profits, then we take market made a move where the price is time to take some profits, then we take profits. But it's more just kind of depending on what the market is doing, especially in this market environment. Risk-wise, you don't want to be holding on positions too much overnight, which is something that you want to do. And risk management is the cornerstone to every strategy you can implement.
Mm-hmm. Yeah, I've noticed you have quite a few videos sharing your wisdoms that you've accumulated over the years. Are you now more excited about helping people, or does trading still provide that level of excitement and intrigue that it did in the beginning?
The helping the people has always been something that I love to do. Always, always, always. So with the story that I'm sharing today about going bankrupt and being responsible for it, because I said I place irresponsible, reckless trades. I wasn't taught to place these aggressive trades. I wasn't taught that way. No trader will teach you to place irresponsible, reckless trades. They teach you maybe to put on more risk safely, as we spoke about. They'll teach you how to have daily stops. They'll teach you about having emotional trigger parameters. Every time I feel this way, I tend to make these type of aggressive decisions in the market. I don't perform well. And helping people kind of navigate with risk management, which is something that is not spoken about so much in the industry, because people I wouldn't say they don't have the confidence, but it is a little embarrassing to say, hey, I lost money. Hey, I was wrong. Hey, I might be wrong multiple times. And it takes a lot of strength to say that. And I want to be the strength for other people to say, hey, he went through that. I'm going through that. I can speak to Alexander. I can resonate with him and say, you know what, let me contact him because I know what he's going through, and we can just chat it out. I get a lot of emails in for just people just voicing what happened in the market. I lost X amount, this happened, that happened. That's perfectly fine. If you just need to journal and just reach out and get it off your chest, you can email me. That's perfectly fine.
Oh, great. Well, how can our listeners contact you?
All the help I provide for retail traders is free. So you can email me as much as you want. It's alexander@traderhelp101.com, alexander@traderhelp101.com. And all my YouTube and social media stuff is Trader Help 101. It's all free. I don't ever want someone to be in a position where I didn't feel that I knew where I could go to get help if I'm struggling with losing trades or struggling with risk management, or how to even begin on to really look at risk management the right way, emotionally, mentally, and financially. It's almost like the retail traders trades by himself. They don't have a risk manager there to close out their trades. They don't have anybody they can go to because they haven't faced something that's going to embarrass them all the time. And it's something that, well, you lost money, you were wrong on this trade, and I feel less than, my self-esteem is down. I don't like making mistakes. I don't like making mistakes on others. And it's magnified by the loss of money. And we don't have the proper training to not only fix a mistake, but fix a mistake that has to do with a financial loss emotionally.
Mm-hmm. Yeah, you've certainly been through many emotional turbulences throughout your experiences over the last, 15 years or more now?
Definitely.
Yeah. Well, thank you very much for coming on Chat with Traders, Alexander.
Thank you, and thank you, Tessa. God bless, and trade safely.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders. Meet traders with pools
and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
The work that you did yesterday on your review, you might not feel that impact until 2 months from now. And by then you will forget that it was that work that actually made it happen. So it's the sum of all the work you did last year that's going to add up this year almost. So I think that's really what shifted my trading from unprofitable to profitable as well. It was that understanding that I need to run my trading like a business.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Yes, this is the Chat with Traders podcast. I'm Tessa, and we're on episode 259. And before we introduce our next guest, I want to take this opportunity to thank the sponsors on our podcast. They help us to cover the expenses and pay the bills to help sustain our efforts to continue bringing value to you. And most importantly, we thank you, our listeners. Many of you are traders in different stages of the trading journey, from the novice and beginner to the developing and seasoned to the veteran traders. Not only is trading one of the few professions that create the most opportunities for unlimited growth and success, financial and time freedom for an individual, most of us as retail traders can technically trade from anywhere in the world. Yet we're still so disconnected from each other. Many of us feel that trading is lonely. I want to remind you that it doesn't have to be lonely. You don't have to feel isolated. Connect with each other. Join a community or group if you're not already in one. If you're already in a community, then take the initiative to get engaged, introduce yourself, reach out to others, share something. It starts from there. If you didn't already know, Chat with Traders has a Facebook group that you can join for free. But we also have a private paid membership community if you're looking for something different, a more focused and intimate space, a place that fosters meaningful connections and purpose and other benefits. Check out the Chat with Traders community on our website at chatwithtraders.com. As a quick reminder, all content on Chat with Traders is for educational and sharing purposes only. Nothing is financial advice. Now, without further ado, I am so happy to introduce our next guest today. His name is Lucas Froelich, best known as the Short Bear, and he speaks with our host, Ian Cox. Lucas came from humble beginnings without formal education, mentorship, or financial resources when he discovered his passion for the financial markets at the tender age of 13. Saving everything he could from jobs, he started trading before he could even legally drive a car. He created YouTube and Twitter accounts to share strategies, victories, and defeats to help fellow traders improve their game. Obsessed with learning from mistakes, understanding gains, and improving his process led to just outrageous gains in 2020 with his agenda trading and quantitative pyramiding strategies. The changing market conditions propelled Lucas into innovating new strategies quite different from what he started out with. His focus, dedication, and discipline for self-improvement allowed him to branch out into new business areas, helping others that go beyond just the trading world. Ladies and gentlemen, we are so pleased to present Lucas Froelich from the Jersey Channel Islands.
Well, Lucas, welcome to